Hello, this is Joe Pryor with the virtualrealestateteam.com in Oklahoma City, a part of Redbud Realty and Associates. This is part 4 in my new series on investing in real estate in Oklahoma City, or investing anywhere for that matter. The last couple of videos that I did, I talked about various ways that we compute what constitutes a good investment. We talked about capitalization rate, cash on cash, and internal rate of return. Today I want to talk a little bit more though about the tax situation. What are some tax advantages that you have in terms of investing in real estate? Well, this is what's really cool. We used in the first example, in the first video, a house that was $100,000. So let's kind of stick with that. That's easy to compute. It's even. What we're going to do is we're going to determine what the improvement value of that property is. Now, this is the good thing about investing in Oklahoma City, because the more you have in improvements, the better tax advantages you're going to have. So for today, we're going to talk about that land is 15% of that $100,000 value. Now, we can go into courthouse records and see how the assessor values land to get an idea that the IRS is going to buy. And so today it's going to be 15%. So that means that the improvement value of the property that we bought is $85,000. Now, there is something that the IRS gives you a break on, and that is called a depreciation schedule. Now, the reason why we computed the land value is that land does not depreciate. You can tear off the house, the land is still there a couple of thousand years, hopefully anyway. It'll still be there as long as the earth is there. And so what we have to do is talk about things that can deteriorate, that have a useful life. And that is the improvements in your house. And so what we're going to do on a residential structure is we're going to take that 85% of that, and that's $85,000 for this example. We're going to take 27.5 years, which is the different schedule that we have for residential versus commercial, which is a different one. And we're going to divide that by 12 and divide it by another 12. Now, let's say, for argument's sake, that when we bought that $100,000 house, that with our payment and all our expenses, like we talked about in previous examples, that our positive cash flow was $250 a month. So that's what we netted after property management, tax insurance, everything that we pay. And so what happens to that $250 a month? If we take that and we calculate it on 12 months, wouldn't that be a taxable event? And yes, it is a taxable event. Now, this is what's called a passive basket taxable event versus active. You still have active income that is based on the IRS rates for how much you make and whether you're married or not. In this particular case, they give it a depreciation schedule. Now, in the case of what I just told you, that's approximately $257 a month in terms of a depreciation. So let's just look at this very simply. We made $250 a month, but we gained $257 in depreciation. So essentially, it's a wash. So what you have at this point, as long as you own that property, is pretty much a tax-free event. Now, there's other things that we can deduct, but we're just talking about taxes right now. So essentially, if we take that $3,000 or so a year that we're making, we're not paying taxes on that. And it is separate from our active income. Keep that in mind. Now, what happens if we're going to sell it? Well, what happens is this. If you take $257 times 5 years, let's say, and that's how long you held the property, and you total that out, well, what the IRS expects you to do is pay 25% of that back in taxes. So whatever that total amount is, what we compute it to be, then you have a 25% taxable event in that case. Now, there's a second tax that you pay, which is capital gains. That's kind of cool too, because in capital gains, you're only paying, at this time anyway, 15% of whatever profit that you make. So if you made $20,000 at the end of that particular time, or whatever it happens to be, after you take your basis down, and we'll get into that in another video, let's say $20,000 is the net after we take our depreciation and some certain other our payments out and things that we put into the house, then we're going to pay 15% on that. So those are the taxes that you're going to do. But the cool thing is while you own the property, you're not paying taxes. Now, in the next video, what I'm going to talk about is a 1031 tax-deferred exchange, which is another thing the IRS allows you to do. And this is going to be kind of a cool thing, too, about investing in real estate, because if it's a good investment, you're going to want more. And this is a way that you can sell that property and not have to pay the capital gains or the recapture tax when you sell that property, as long as you put it into other investment property. This is Joe Pryor with the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.